Well, hello Dragons, and welcome to this instructional video for Lesson 8, Part 3, Monetary Policy Strategies. The main idea behind this economics lesson is the Fed attempts to promote economic growth and stability through its monetary policy. With that in mind, by the end of watching this video, you'll be able to explain why the Fed relies on either an easy money policy or a tight money policy, examine how the Fed makes monetary policy, and identify the challenges associated with determining monetary policy. Now that the outcomes for this lesson have been shared with you, let's get started. The services provided by the Federal Reserve make the U.S. monetary and banking systems more efficient and sound. The major goal of the Fed, however, is to promote the goals of economic growth and stability. The Fed tries to achieve this goal through the use of monetary policy. Through its monetary policy, the Fed regulates the amount of money and credit available in the economy. Monetary policy is the plan to expand or contract the money supply in order to influence the cost and availability of credit. By regulating the money supply and the interest rates charged for credit, the Fed influences aggregate demand. Aggregate demand is the total demand for all products in the economy. As you also know, demand requires that consumers be willing and able to buy a product. Aggregate demand has the same requirements, but reflects demand for all goods and services in the U.S. economy rather than for a particular product. The Fed measures both the money supply and aggregate demand in order to develop a monetary policy. Based on the amount of money and the spending habits of people across the United States, the Fed adopts either an easy money policy or a tight money policy. An easy money policy is designed to expand the money supply, increase aggregate demand, create jobs, and thus reduce unemployment and promote economic growth. The Fed usually adopts an easy money policy during a recession because the economy needs a financial boost. By charging banks a lower interest rate to borrow money, the Fed makes more money available to those banks. When banks pay less in interest on loans from the Fed, they are able to lower the interest rates they charge their customers. When banks charge lower interest rates, people and businesses borrow more money. Increased borrowing and spending in turn stimulate economic growth as businesses make more products and hire more workers. Businesses then expand by investing new capital. Suppose that the Fed charges a lower interest rate to banks, and as a result, bank interest rates on car loans drop from 8% to 6.5%. Samantha decides that because interest rates are lower, she can afford to borrow money to buy a car. As other consumers make similar decisions, demand for cars increases. Automobile producers hire more workers and provide more cars. These workers have new income and further stimulate aggregate demand. In contrast to an easy money policy, a tight money policy slows business activity and helps stabilize prices. The Fed may determine that inflation is likely to develop because too much money is circulating and credit is too accessible. To restrict or contract the money supply and thus limit credit, the Fed adopts a tight money policy. A tight money policy is characterized by higher interest rates and a contraction of the money supply, both of which are designed to reduce aggregate demand. Suppose that Jack wants to buy a new dishwasher. He discovers that interest rates on loans have increased. Jack decides to delay his purchase until interest rates decline. As other consumers also postpone purchases, aggregate demand declines. How does the Fed put monetary policy to work? There are several ways the Fed can influence the money supply, the availability of credit, and aggregate demand. The key components of the Fed's monetary policy are open market operations, the discount rate, and the reserve requirement. The Fed also has other formal and informal ways to affect aggregate demand in the economy, including margin requirements, credit regulation, and moral suasion. The main tool of the Fed is open market operations, or the buying and selling of government securities. The Federal Open Market Committee, or FOMC, makes decisions to buy or sell government securities based on the monetary policy set by the Board of Governors. The Federal Reserve Bank of New York conducts the transactions through private securities dealers who buy and sell billions of dollars worth of government securities in a single day. How does the Fed decide whether to buy or sell government securities? If the Fed wants to contract the money supply, it does so by selling government securities. The cash paid for the securities is ultimately withdrawn from bank reserves, thus shrinking the money supply and decreasing aggregate demand. When the Fed wants to inject money into the economy, on the other hand, it buys back government securities. The buyback money paid for these securities ultimately winds up in individuals' and businesses' bank accounts, increasing cash reserves and loan pools. When the government buys securities directly from a bank, the bank's reserves similarly are increased. Either way, the money supply expands. As more money enters circulation, banks make more consumer loans, enabling consumers to purchase more goods and services. To meet this increase in aggregate demand, production rises and the supply of goods and services increases. A second major component of the Fed's monetary policy is the discount rate, the interest rate that the Fed charges member banks for the use of its reserves. It adjusts the discount rate to encourage or discourage borrowing. The Fed extends short-term loans to commercial banks to help them maintain sufficient cash reserves. Banks generally attempt to borrow from the Fed only after they have exhausted all other methods of meeting their temporary cash shortfalls. Lowering the discount rate encourages banks to borrow, increasing the reserves that banks can in turn loan to businesses and individuals. Conversely, increasing the discount rate discourages banks from borrowing from the Fed. Changes in the discount rate can directly affect the interest rates charged by banks and other financial institutions. Banks and other lenders often pass on the savings from decreases, or costs from increases, in the Fed's discount rate to their consumers by lowering or raising their prime rate. The prime rate, the interest rate that commercial banks charge on loans to their most reliable business customers, is then used to determine the bank's general interest rate. As interest rates fall and consumers and businesses take out more loans, the money supply increases. Why? An interest rate is the price of borrowing money. When the Fed lowers the discount rate on loans, charging commercial banks a lower price for borrowed money, banks can then decrease the interest rates they charge individual borrowers. A third part of the Fed's monetary policy is its reserve requirement. The reserve requirement is the money that must be held by banks either in their own vaults or in their accounts at the District Federal Reserve Bank. As you have learned, the reserve requirement ensures that banks can meet demand requests. The reserve requirement is a percentage of each member bank's total net transaction accounts. In other words, the Fed determines how much money is in transaction accounts at each member bank, and requires the bank to hold a percentage of that in total reserve. Prior to the COVID pandemic, the reserve requirement was 0% for banks with less than $16 million in deposits, 3% on all such funds on deposit up to $122.3 million, and 10% on funds over that amount. Banks are not required, however, to hold reserves on time deposits and other accounts that are less liquid than checking accounts. The Fed can increase or decrease the money supply and influence aggregate demand through its control of the reserve requirement percentages. When the Fed lowers the percentage, banks do not need to hold as large a portion in their deposits as reserves. The result is that banks can extend more loans. The combination of more money and easier credit produced by the easy money policy serves to increase aggregate demand and production in the overall economy. By raising the percentages of the reserve requirement, on the other hand, the Fed forces banks to hold a larger portion of their deposits as reserves. This enables banks to cut back on their lending, thus contracting the money supply. As the supply of loanable funds shrinks, interest rates rise. As a result, aggregate demand and production slows down. The Fed uses such a tight money policy to fight inflation. The percentage requirement changed annually according to a formula specified in the Monetary Control Act of 1980. The Fed does not often make frequent or dramatic changes to the reserve requirement, however, because such changes would create uncertainty in the banking system, thus making it more difficult for banks to make long-term loans and investments. The Fed also places indirect controls on credit as part of tight money or easy money policy. The Securities Exchange Act of 1934 authorizes the Board of Governors to set margin requirements, or the percentage of cash an investor must have to buy stocks, options, and other investments. If, for example, the margin requirement is set at 60% of the stock's value, the investor must put up 60% of the investment's purchase price in cash. The remaining 40% can be purchased with credit. Suppose that Elise wants to buy 100 shares of a stock priced at $10 per share for a total of $1,000. She will need to pay at least $600 in cash, buying no more than $400 of stock with credit. The goal of margin requirements is to prevent the occurrence of wild price fluctuations caused by over-reliance on credit in the purchase of securities. A high margin requirement discourages investment in the stock market. Low margin requirements, on the other hand, may make stock investing more popular. Since the stock market crash of 1929, the Fed generally has set relatively high margin requirements. A second indirect control is the Fed's power to regulate consumer credit in times of national emergency. During World War II and the Korean War, for example, the Fed required high down payments and shorter repayment schedules for consumer loans. These requirements limited the availability of credit, as many people were unable to meet the requirements. As credit became more expensive, fewer people chose to buy consumer goods. The new, lower level of aggregate demand led producers to reduce supply. The government then was able to encourage many suppliers to produce war-related products. The Fed coordinated its consumer credit policies with its easy or tight money policies. Suppose that Evelyn decides to borrow money so that she can convert her garage into a spare bedroom. Under an easy money policy, she is able to arrange for a long loan repayment period. If she borrows money while a tight money policy is in place, however, she may have to make higher payments over a shorter period of time. The Fed's ability to regulate credit was revoked in 1952. In addition to its official tools, the Fed can informally restrict aggregate demand in the U.S. economy. Moral suasion refers to the unofficial pressures that Federal Reserve policymakers exert on the banking system. Moral suasion can be a direct appeal to individual commercial banks through letters and conferences, public announcements through press releases, and testimony before congressional committees. These techniques enable the Fed to influence banking practices without imposing formal regulations. Through the use of moral suasion, the Fed attempts to channel the lending policies of all banks in the direction it desires. The enormous size of the U.S. economy presents a number of obstacles that the Federal Reserve must deal with in order to carry out its duties. The Fed's main challenges are economic forecasts, time lags in developing and carrying out monetary policy, priorities and trade-offs, lack of coordination among government agencies in formulating economic policies, and conflicting opinions about monetary policy. To develop monetary policy, The Fed first must create an economic forecast, or a prediction of future business activity and consumer spending. Will automobile production increase or decrease? How many laptop computers will be sold? Will consumers buy more gasoline? These economic forecasts provide the assumptions on which the Fed policies are made. Making these forecasts is a difficult task, however, because the U.S. economy includes millions of economic actors, products, and markets. Incorrect forecasts can lead to inappropriate policies. Once an economic forecast is developed, time passes before policies go into effect. These time lags are the unavoidable delays that occur before government agencies are able to put their policies into action. Three types of time lags disrupt the effectiveness of the Fed's monetary policy. First, collecting and studying the tremendous amount of economic data needed for analysis and action by the Federal Reserve can take months. Second, once the data have been studied, time-consuming discussions occur before agreement on an appropriate monetary policy is reached. Third, additional months may pass before the impact of the monetary policy is felt throughout the economy. Consumers and businesses need time to adjust their buying and selling decisions to tight money or easy money policies. Aggregate demand and business activity seldom react instantly to the Fed's actions. A third limitation on monetary policy is that it cannot do more than it is designed to do. Monetary policy is designed primarily to fight either inflation or recession. In some cases, certain economic policies used to remedy one problem may make another problem worse. For example, an easy money policy fights the problems of recession, but often causes an increase in inflation. Conversely, a tight money policy is effective in combating inflation, but it tends to decrease business activity and contribute to recession. The Fed must weigh trade-offs and establish priorities for the nation's various economic challenges to develop an effective economic policy. A fourth limitation on the Fed's actions is that other government agencies sometimes target different economic priorities than those identified by the Fed. This lack of coordination among government agencies can hinder economic stability and often sends mixed signals to the market. During the early 1980s, for example, some economists believed that both the government's monetary policies and its fiscal policies seemed to contradict one another. The Fed's tight money policy, targeting inflation as the nation's chief economic problem, sought to restrict the money supply and reduce aggregate demand. At the same time, however, Congress and the President approved massive tax reductions and federal spending hikes. These actions increased demand and total spending in the economy. A final limitation on monetary policy effectiveness is the disagreement some economists have about the Fed's priorities. For example, monetarists are economists who believe economic growth and stability result from regular, long-term alterations to the money supply. Monetarists argue that the Fed's manipulation of the money supply and aggregate demand damages the economy rather than improving it. Monetarists believe that the Fed should increase the money supply by an established amount each year rather than responding to short-term ups and downs in the economy. The disagreement over the goals of U.S. monetary policy among policymakers underscores the fact that economics is not an exact science like physics or chemistry. Because of this lack of certainty, the Federal Reserve and other government agencies cannot develop policies that consistently solve all of the complex economic issues in the United States. So that's the way it is with Lesson 8, Part 3, Monetary Policy Strategies. At this point, you should know that an easy money policy is characterized by low interest rates and is used in times of recession to expand the money supply. A tight money policy is characterized by higher interest rates and is used during periods of inflation to slow business activity and stabilize prices. The Fed's three major tools of monetary policy are open market operations, the discount rate, and reserve requirements, and several factors can limit the Fed's actions. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons.